Good morning, friends. I hope uh, you're having a good start to your weekend. Now, as I've promised, we'll be doing a video to see, how previous session or previous time period levels can help you. Now, what is the reason for this? These days, I see, very comprehensive courses which are being sold, which have, I think, tons of chapters on, this pattern and that pattern and, you know, put call ratio and how do you read option chain, etc. That, according to me, is a very complicated way of doing things. I belong to the Virender Sehwag school of life, where if you think too much or if you are looking at 10 things, you can never apply it in a very effective manner. So let's see what I have to present to you, and then you make your own decision. First, on a whiteboard, let me explain to you what exactly are we looking for. Okay, now say, for example, you have your three levels: the high, the low, the high, and the close for a previous session. Now the highs are created by the bears. So this is where the market went up and it could not go up any further. So the bears pushed the market lower. The lows are created by the bulls. The bears tried to take it lower, but bulls came back, and from this level they took the market up. And this close is the final price where yesterday's battle was settled. Okay, so high, low, and close of the previous time period. If you are an intraday trader and you're looking for a 40-50 point Nifty style move, then that is your time frame. If I want 250 points, I would look at similar levels from the previous week. If you're a monthly trader, you would look at levels from the previous month. Basically, what I have found is that the intraday guy needs to be aware where the weekly levels are and where the monthly levels are. The weekly guy needs to be aware where the previous week and the previous month levels are there. And you can say that the monthly guy probably needs to know where the monthly and the yearly levels may be there. Okay, so you have to know higher time frame levels. So if I am a weekly person, see, monthly levels will not come every second day. So as a weekly trader, I should be aware of three levels of previous week and three levels of previous month, which is high, low, and close. Okay, now very important that you understand the concept of rejection. This is a level, right? Often two things can happen here. The market goes to this price and immediately is rejected, or the market goes to this level and starts to move sideways and is and accepts this price and moves up. Okay. Now, you have to use some sort of finesse. These prices are matched some of the time. So like day before's close was 11,896. Okay. Yesterday the low was 11,907. So for the purposes of trading, this level has been matched. Okay. If you start to see rejection from 907, this level has done its job. A lot of people are saying that on the slide I have put that last month's high is this month's low. Now last month's high was 11,626 and this month's low is 11,670. So don't be an idiot. On a monthly chart, this is as good as the level being hit. Okay. If you want to, talk rubbish, I cannot help you. Nobody else can help you. But all I'm trying to say is that the exact levels will come only some of the time. Okay. But what's important is that how strongly the market rejects a certain zone. Like on the Infosys results, the market came down strongly. This first 5-minute bar was 50 points. So often there is a result because of which the market gaps up or gaps down and from lower levels finds rejection. Now, on an intraday basis, you can see what happens. You have sudden collapses these days, and all of a sudden, the market starts to rally. These are stops. Because of huge intraday activity, the moment market starts to come off with any kind of momentum, the intraday stops are hit. And if it goes up, similarly, the stops of the short positions are hit. Okay. Also, these things can be used as a trigger. Say yesterday's high was 11,970. Today you went up to 12,000. Okay. So in case the previous high starts to get broken from the higher levels, we would accept even this as a rejection of the previous high. So this can be used for trading. Important bit is anything that gives you advance information, anything that prepares you ahead of time, that is useful in trading. Okay. So let's go back and see how we can use this on a daily basis. On a weekly basis, what often will happen is that you will get, couple of trades in a week. On a daily time frame, you will get possibly 3 to 4 times in a week. Okay. But if you know what you are looking for, then that makes your life easier. Okay. Now let's look at the Nifty first. On the Nifty, yesterday was a very narrow range. So as we can see here, the Thursday's session had a high at 11,885, had a low at 11,824, and it closed around 11,904. So it is actually closer than what I was thinking. So 11,904. So today on Friday in the morning we opened at 11,951. So immediately we went up and there was no high here. So there was no level to look at. So we came down, and we made a low at, this is the futures price, which is 11,910. Yesterday close, I think this is the bar. This is the adjusted bar, but I think the actual price probably was 904. Immediately you started to see this sort of hammer pattern. This is a rejection pattern. Now this one here has rejected this price level. Okay, so an intraday trader would have bought on this red candle, the next candle which held the low, would have put a stop below this, and he could have had a ride towards 970. Narrow range day, so obviously narrow range day will have narrow range moves. Okay, again let's look at a previous day. I am not choosing days, but obviously certain days work better than the others. Okay, now this is that big volatile day. Again, where has it closed? It has closed at 11,937. The Thursday session opened and made a high at the previous session close, and immediately you saw a shooting star. Okay, so again from previous session close, the market has found resistance, and during the day, you know, opening at 11,935, you got almost 100 points lower. Again, very narrow range, choppy day, but you can see ahead of time, you knew where the previous session close was there, and you could have done something. Now let's look at another day. Now this was that day which was the big volatility day. Now 12,000 is a weekly level. We all know that. So at this zone, what you could have done was, as the market started to reject, rejection means this green candle started to get taken out by this red, and then you had these two small candles, and the market was giving up 12,000. Out here, if you bought a 11,900 weekly put, that put would have become 3 times. So again, ahead of time, you knew there was trouble at 12,000. So this way, what you can do is be prepared for rejection, because you know where the rejection may come in. See, lots of people have great amount of trouble with impulsive trading. Okay. But if you have this sort of levels in front of you, life becomes very easy, because till you are not at a level, you stay out. Okay. So we had a weekly 12,000 level, which we could have played with. B, even if say you did not see the weekly zone, although 12,000 is hard to miss, the other way, at least you could have gotten into uh, this trade would be, you had this previous session high at 11,950. So the moment you had this huge candle go through 11,950, that was an indication that you could have taken that short trade. Now the interesting thing is this 11,760. If we go to the weekly chart, the close of previous week is 11,762. So you had this idea that somewhere in this 11,760, 800 type of zone, you could have a low. So again, it helps you with targets also. Okay. So basically, what I am trying to get at is that you have three levels at the beginning of every week. You have three levels at the beginning of every day, and it is possible to use them in trading. So if we go back to the weekly chart now, we've discussed enough examples on daily. Previous week, the information we had was 12,025 was the high, 11,762 was the close, 11,661 was the low. So here we got both 11,762 and 12,025 thereabouts. So you had two nice trades from 12,000 downwards and from 11,762 upwards. Okay. Now let's look at monthly also for once. The previous month gave us three levels. High was 11,617, low was 10,791, and close was 11,247. So again, as you can see here, this month, what you have found is that on a smaller time frame, you got a decline where the low was 11,661, which is within kissing distance of 11,617. So monthly levels are also very useful, because once you get below the weekly low, you have to look for a monthly level. So this is the broad gist of the story, and let's look at some examples from Bank Nifty. Bank Nifty, if you look at the intraday type move, previous session high was 24,685. Okay, this session's high was 24,756, kissing distance, plus you got your shooting star. Immediately you would have gone short and you got your 6 bars on the downside. Again, here you had this 24,800. Okay, now on a previous session basis, there was no way you could have had a high which was near this. So in this case, what you could have done is you could have used the Nifty 12,000 to take a trade on the Bank Nifty. So a trader has to be very intelligent in terms of using his levels. Okay, let's see if the weekly gave us some extra information. On the weekly basis, previous week levels were 24,190 was the high, 22,970 was the low, 23,533 was the high. So there was no way you could have had a previous week telling you what to do. Okay, so sometimes you will have to use one index to get a guesstimate on the other index. Okay, now here, if the market straight away is opening above all levels of a previous session, that means it is straight away rejecting the previous session high. And often chasing the market in this sort of manner, see, this is a rejection of the previous session high, although it hasn't touched it. So rejection is the most important issue here. This was the previous session high. This was that 300-point down move. So Bank Nifty first crossed the previous session high, unable to sustain. And the moment we started to reject with this sort of a red bar below 23,951, you could actually get a 1,000-point down move. Okay, so that is how you have to play these levels. Now on the 15th, we rejected, I think, the low of the previous session. This was the day before the 300-point down move. This is your low and the close, which are about the same. So the moment we started taking out this low of 23,435 on this day, look at the kind of strong move you got, because people's stops were here. So every day that we enter, we have three levels to work with, and we have to be able to make the best use of them. So on individual stocks also, I think this methodology can be applied. If you look at Reliance, on Reliance, Yesterday's example is important. The day before's low was about 2092. Yesterday's low was 2097. So within 5 points, you got this rejection bar and immediately you got your 20 points on the upside. Here, the low was 2154, okay, of the previous session. The moment 2154 broke, you got this strong downside move. So the idea is that you had this close level with you, and the moment market started to come down, you got a serious level of decline. Okay, so this is how you should be trying to trade these, you know, amazing levels. Let's see the weekly chart on Reliance. The previous week low was 2172, close was 2175, and high was 2304. So we started trading above 2172 previous week's close, and the moment we started to give up this 2172, we had a large action on the downside. I hope this would have helped all of you, and it will come with practice, but at least for Monday, you have the weekly and the daily levels with you. Take care, trade well, and please consult your financial advisor before putting up any sort of real money. Have a good weekend.